I think the world economy is still substantially affected by the Great Recession and the associated global financial crisis, and particularly the adverse developments that had occurred in real estate markets. So I wanted to start today by saying something about the size of the Great Recession and some indicators of that, just taking a little time on that part. And then I wanted to link those observations to subsequent and ongoing research related to uncertainty in macroeconomics, and specifically to analyses of rare macroeconomic disaster events, of which the Great Recession may or may not fit into that classification. So let me just look at rough indicators of the size of the recent Great Recession, starting in 2007, continuing into early 2009. What do I do here? There we go. So this is a simple picture for the U.S. Economy, showing the Great Recession in the U.S. context, 2007 to 2009. So the decline in GDP in that period accumulated to about 5%, or about 6.5% if you do it in per capita terms. It looks larger if you do it relative to trend, and then you get up to something like 9%. In any event, this is the biggest recession of the post-World War II period for the U.S., and in that sense, it's a very important event in the U.S. context. I don't think it quite rises to the magnitude of the usual metric that one takes, or at least that I have taken in thinking about when something is a great macroeconomic disaster or not. Maybe a more prominent feature of the graph, which is also well known, is that the recovery since the recession has been strikingly weak. The average growth rate since early 2009 is only around 2% per year, which is below the long-term trend of real GDP growth, which is around 3%. May or may not be the right long-term trend to look going forward. But of course, if you're growing at a rate below the normal trend, it means you're not catching up at all. There's essentially been no recovery in that context in the U.S. since the end of the Great Recession. If you do it in a global context, the U.S. is not special in terms of the Great Recession. The U.S. is roughly in the middle if you compare with long-term OECD members with respect to how large the Great Recession was. So this is just some metric for 21 long-term OECD member countries. This is in terms of per capita GDP decline during the Great Recession. The U.S. is at 6.6% at the bottom, which is just about the average for this group of countries. As another indicator of the extent of the Great Recession, you can think about what happened in the U.S. stock market, which I think is partly a concern, a reflection of what happened, but also in terms of what was viewed as prospectively going to happen at the time. So the U.S. stock market plunged, particularly in the period going up to 2009. And that, in fact, is the second worst decline in the U.S. stock market over this history back to 1913, second only to the plunge during the Great Depression from 1929 to 1932. So I think, in fact, what that indicated was that the markets were expecting something worse than actually materialized. And in that sense, there was a fortunate outcome that the contraction in the economy was only about 5% or 6.5% in per capita terms. I think the stock market was actually anticipating something much worse than that. And there's been quite a substantial stock market boom since the bottom, since 2009. And frankly, I'm surprised that the stock market is so optimistic. And as a related matter, along with the strong performance of real stock prices, various indicators of volatility have come down a lot in this period, including things like the VIX index of stock market volatility. So I find that all surprising. And if I were more like Bob Shiller, I would say the market's clearly being irrational and not understanding that this is a bubble in terms of the stock market and it's going to collapse. And it would be very comfortable to have that outlook. Sometimes I wish I had that perspective where I can just label markets as being crazy and bubbles as being occurring all the time. And I just can't quite get myself to do it. But you could certainly make a case along those lines, and it certainly is surprising to me. A general perspective, which I agree with, is that the real estate markets were central in terms of the Great Recession, particularly in terms of the U.S. pattern and perhaps the origination of the problem from the U.S. economy. And I think it's accurate that the private sector underestimated the riskiness of real estate-related securities. I think that was clearly the case. I don't think anybody thought it was conceivable that national average real house prices in the U.S., for example, could fall by 40% in a short period. And I think that underestimation of systemic risk was important in the crisis. So this is what the kind of familiar Case-Shiller-based picture looks like in terms of real house prices in the U.S. And of course, you have this large boom here by about 85% in terms of national average real house prices. And there have been a lot of stories about what the origins were for this boom. But then a standard view is that at some point this bubble in the housing market burst and was followed by a very sharp decline of accumulating eventually to 40% in real terms. So that decline started around 2007 with a peak in 2006. So that's what's stated here. Now, there's been a recovery to some extent since 2012 in terms of average real house prices. The recovery has been by about 14%, which is, of course, only a very partial recovery from the extent of the 40% decline. So the level is still substantially depressed relative, for example, to the 2000s, and is now close to where the market was in 2001. I think as a general matter, some of this is conjecture, that there's been too much emphasis placed on residential housing prices and not enough on commercial housing prices. And I think actually this ties in quite closely to the Lehman collapse in September 2008. So if you look at an analogous index of commercial real prices, you can see that here on the blue graph. Now, this is an index that's been constructed going back only to 2001. It was originally done by Real Capital Analytics, which was bought out by Moody's and is now being published by Moody's. You can see that in this initial period, there's a run-up in both commercial and residential real estate prices. Now, there's an important difference here. The peak in the residential is in 2006, and the big decline starts in 2007 over here. So this is the decline in residential. Commercial real estate prices are still going up at that time, and the decline on the commercial side actually starts only in 2008. That's the blue graph. Now, the reason this is particularly important for the Lehman collapse, and some of this I say is conjecture, is that Lehman was different from its peer broker-dealer institutions in the extent of its concentration on commercial real estate. Now, Lehman was adversely affected by the drop in residential real estate prices, but the really distinguishing feature of Lehman was its investment on the commercial side, and that became a big negative only when the commercial prices started to decline really in 2008. So the collapse of Lehman is around here, and I think it's this collapse in the commercial real estate prices that really underlay the timing of when the Lehman bankruptcy occurred. And of course, that fed into a lot of other problems in terms of the financial crisis and in terms of the ongoing real estate crisis. So I think it might be a good idea in terms of research to put more weight on what was going on in the commercial markets compared to the residential. And it's actually true that since the bottom, the commercial recovery has been much more rapid than the residential real estate price recovery, which starts here. A few words on monetary policy. First, I found it quite reasonable in the wake of the financial crisis and the Great Recession that the short-term nominal interest rate was cut to essentially zero by the end of 2008, going into 2009, and has basically been maintained there. And I didn't really have any quarrel with that part of the Federal Reserve policy. The more unusual part of the Federal Reserve's policy, which is not completely unique to the U.S. Central Bank, is this business, related to quantitative easing, which has shown up in terms of an expansion of the Fed's balance sheet by over $3 trillion now. I must say, since I go to China fairly often, I became less impressed with the $3 trillion figure when I learned that the Chinese central bank has expanded its balance sheet by $4 trillion. And of course, the Chinese economy is not really quite as big as the U.S. economy. So I became a little less impressed by the $3 trillion number, but nevertheless, it's a very large amount. I particularly didn't appreciate the vast expansion of residential-related mortgage securities by the central bank, which is about half of the total expansion. If you look at the Fed's portfolio, it's essentially financing with short-term overnight loans, which are mainly excess reserves held at the central bank. And it's holding various risky securities, which are particularly related to residential mortgages. So it doesn't look all that different from Lehman's balance sheet in September 2008 in that respect, except that the Fed is not holding commercial real estate. Of course, recent programs of quantitative easing have focused more in terms of the more conventional open market operations involving treasury bonds rather than mortgage-backed securities. My view is that various phases of QE do not have much economic content and don't really mean much in terms of the effect on real GDP growth. The U.S. Treasury has some kind of incentive to have a maturity structure of its public debt. So it doesn't, for example, issue everything in terms of short-term Treasury bills, but rather has a maturity structure which includes longer-term bonds. And I think you can rationalize that form of behavior from an optimal public finance perspective in terms of why you wouldn't want to fund the federal government entirely with short-term borrowing. So if the Fed comes in and buys up a lot of long-term bonds and then issues the equivalent of short-term bonds, which correspond to the excess reserves held at the Fed, then the Fed is basically lowering the maturity of the structure of the outstanding debt that's held by the private sector, that is not including what's held by the central bank. Now, the first point is that the Treasury presumably had some reasoning behind its initial choice of what maturity structure to have. And if the Fed comes in and buys up a lot of long-term stuff and substitutes short-term, you would expect the Treasury to offset that. And I think the Treasury has offset about half of what the Federal Reserve has done in terms of trying to reduce the maturity length. Secondly, the substitution from long-term to short-term government bonds, you would not expect that to have a major impact on the economy. It might have some minor impact related, for example, to public finance, but you wouldn't anticipate that this would be a major kind of policy intervention that would affect GDP growth to a large extent. So mostly I think that this QE doesn't mean very much. Now, on the opposite side, you might think there's a downside to this policy because there's a question of what does the Federal Reserve do when it's going to try to have an exit strategy offsetting the expansionary phase of the, for example, reserves held at the Federal Reserve. So if you ever return to normalcy, where short-term interest rates become something substantially above zero, you'd expect that to be accompanied by a reversal of the QE phenomenon and a substantial decrease in excess reserves held at the Fed. The nature of that exit strategy, I think, is not well understood. I don't think it's ever happened. I think the Fed is over-optimistic in terms of how it can manage this exit strategy. But I must say, I think the most favorable outlook is consistent with my view that it didn't matter very much when the Fed expanded the balance sheet by $3 trillion and correspondingly reduced the maturity structure of the outstanding government debt by buying up long-term bonds. If that doesn't matter very much, then the same reasoning would suggest that reversing it also won't matter very much. So they should then be able to have an exit strategy that is at least mostly harmless. I think that's the most favorable view of QE. It didn't matter too much on the upside, and it won't matter too much on the downside. And in that case, it's not a major concern. Now, if you told me 6, 7 years ago that the Fed was going to expand its balance sheet by $3 trillion and asked me what I thought would be happening with inflation, I would have said that it would be highly inflationary. So I've learned something by these events. It hasn't been inflationary, and moreover, expected inflation is still quite low, gauged by indexed and conventional Treasury securities. I think this is because, as an outcome of the Great Recession, you had a corresponding large increase in the demand for safe assets, along with a dramatic expansion in the supply. So you have people willing to hold excess reserves at the Fed at extremely low nominal interest rates. And I think that willingness to hold these quote-unquote securities is what accounts for the fact that the vast increase in the usual monetary base has not been inflationary. But I certainly admit, if you'd asked me about this 6 or 7 years ago, I would have had a different perspective. So I think there are a number of important sources of policy uncertainty, which I think are a big negative in terms of looking to the future and to the possibility of bad things happening to the U.S. and the world economy. There's a lot of discussion from the fiscal side, which relates in part to entitlement programs of the federal government and also to state and local governments. And I think there's tremendous uncertainty as to how that's going to be resolved. So I would have labeled that as one potential negative. Monetary policy, as I've discussed already, I would have thought is also a source of uncertainty in terms of exit strategies. But maybe, again, that's not so important along the reasoning that I presented before. So let me try to tie this perspective on the Great Recession into research on rare macroeconomic disasters and to uncertainty more generally in terms of macroeconomic effects. So one side effect of the Great Recession and the associated financial crisis since 2007 is I think there's been a great increase in the receptivity to models of asset pricing and macroeconomic dynamics that relate to the evolution of uncertainty and to the potential for rare macroeconomic disaster events. Rare macro disasters, I would say, originates from a comment on the Mirror and Prescott paper by Reitz, which appeared initially in 1988 and was largely ignored until much more recently. And I think partly as a consequence of the Great Recession itself, I think there's more attention to that line of research. Some of the initial work was focused on explaining the equity premium and a low risk-free rate. Gabex has particularly argued that the perspective for rare macroeconomic disasters seems to explain an array of asset pricing puzzles, so that there's more explanatory power than just thinking, for example, about the equity premium. Some models have focused on the role of evolving disaster probabilities or potential sizes of disasters as components of business cycle models, some of which are closed economy models and some of which are open economy. So there's some recent work, for example, by Gorio and by Farhi and Gabex along those lines. A more recent paper by Schall et al. Argues that there's an important two-way causation between uncertainty and the macroeconomy. So you have kind of a standard channel, which goes back at least to Bernanke, about how higher uncertainty can depress investment and thereby have an adverse impact on the overall macroeconomy. But the new element in this recent paper is that lower economic activity itself, by decreasing the flow of information, can raise uncertainty. So there's a two-way direction of causation that's highlighted in this interesting recent paper. To do research on rare macroeconomic disasters, if you're trying to infer the probability and potential sizes of these events from actual history, you need two things. You need lots of countries, and you need very long time series. That's because the nature of rare macro events is that they don't occur very often. And if you're trying to get some sense on the probability of these events, you need very long time series for many places. So this research was aided considerably by efforts from my former PhD student, Jose Ursua, who did a lot of work in expanding the available long-term national accounts data. Now, he started with the famous data that have been assembled by Angus Maddison for many countries over long periods. Frankly, our initial idea was that we were going to use Maddison for GDP, which is what he looked at, and then expand it to look at something like consumption, which is what appears in usual asset pricing analysis. But when Ursua looked in detail at the Maddison data, particularly as applied in crisis periods, which we were most focused on, he found a lot of problems with the way these data were put together. So I would suggest that people who are interested in long-term national accounts analysis use the data that Ursua has put together, and I think it's very much superior to the Maddison data, especially if you're interested in macro crisis type events, as opposed to just looking at longer-term economic growth. Anyway, the combination of the national accounts data that Ursua put together with expanded long-term data related to asset returns, including stocks and bonds and bills, especially put together by global financial data, I think has been a great assist in terms of looking at rare macro disaster events over long periods and their implications. So when I first looked at these data, I took an NBER style, kind of primitive but nevertheless fairly effective approach of computing peak to trough declines in per capita GDP during certain recessionary events. And when those declines over short intervals accumulated to more than some threshold number, which was either 10 or 15% in some of this analysis, that was what I labeled as a rare macroeconomic disaster, although the specific threshold is not really central to the results. So if you take the approach of these peak to trough measures, using 40 countries over more than 100 years, typically for each country, so that's about 5,000 annual observations in total. You can compute from that the disaster probability per year is about 4%. So that's the chance in any particular moment in time of entering into an event which eventually accumulates to a decline by at least 10%, and that's what's considered to be a rare macro disaster. So those data look like these histograms. So if you look, for example, at the two bottom panels, that's for GDP. The upper panels are for something closer to consumption, but I'll focus on the GDP numbers. So for the 40-country sample observed over roughly 100 years for each place, but this was ending in 2006, which is related to when this was first looked at. It turned out there were 183 rare macro disaster events. That's what corresponds to the annual probability of 4% per year of entering into one of these events. And the size distribution, how much the GDP decline accumulated to, is shown on this lower left panel. The biggest one, this is Germany at the end of World War II, where the decline in the last, from really 2 years, was by about 70%. That's the biggest event. And then there's a distribution of these events, which perhaps approximates a power law in terms of what the function looks like. Anyway, these are events subject to the fact that they have to be at least 10% to qualify to be on this diagram. And this is the distribution of the duration of these disaster events, which turns out to average around 4 years. This is where the major events occurred in the history going back to 1870. The biggest event is World War II, which had 25 rare disaster observations, averaging about 37%. I find whenever I go to China, they think the only reason the U.S. economy ever grows is because the U.S. fights lots of wars. But in general, wars are really not good for the macroeconomy, and the U.S. is kind of an outlier in terms of how it did during World War II. Overall, war is really bad for macroeconomics. World War II is the biggest thing, and then World War I and the Great Depression. Those are the three biggest sets of events in this categorization. So the main events that associate with rare macro disasters are wars and depressions, which typically involve financial crises, sometimes housing crises. The only other event that we isolated in this research that was not of that character was probably the great influenza epidemic, 1918 to 1920, which I'm not completely sure of because it's hard to separate from World War I. But we didn't find any other events that were big enough at the country level for the 40 countries in the sample. So, for example, there were no hurricanes or tsunamis or whatever that were big enough to produce 10% declines in per capita GDP over the sample. And, of course, there were also not environmental disasters that were big enough over this sample to show up as 10% declines in GDP. So the events that we did find were dominated by wars and depressions. Recently updated this to the Great Recession, which I think potentially could have added many cases of rare macro disasters. In terms of the way it worked out, for the 40-country sample, the only two that are in the data are for Greece and Iceland. Those are the only reductions that were 10% or more in per capita GDP associated with the recent Great Recession. This is if I look at the 40-country sample where we have the long-term data. So it doesn't really change the picture very much. I wanted to say a few things about my and others' ongoing research related to this area. So in a recent paper, we extended the baseline rare macro disaster model to allow for recoveries from disasters and also to allow for the finite durations of the disaster events, rather than thinking of disasters as being jumps that occur downward in a second or something like that. The recoveries turn out to be particularly important. It's very much true in the data that once a macro disaster ends, there's a tendency to grow for a while at above normal rates, and it eventually recovers about half of the GDP that was lost during the disaster event. That's what we estimated. We also allowed in this paper, which is joined with Nakamura and Steinson, for correlation across countries in terms of the realization of these rare disasters. So that's particularly true for wars and the Great Depression, and it might be true also for environmental disasters of the sort that are getting a lot of attention these days, but again, there are none of these in the sample. Another important issue in this line of research is explaining the volatility of asset prices and rates of return. The baseline model doesn't have enough volatility, for example, in explaining why the stock market is so volatile. So two extensions that are important there are allowing for time variation in the probability of disasters or in the mean and variance of the long-run growth rate. So this latter extension is the one that's explored under the heading of long-run risks by Bonsall and Yaron. They focus on evolution of the long-run growth rate. I think, in fact, variation in the probability of disaster is quantitatively more important, but both of these can explain volatility in price-dividend ratios and therefore in asset prices and rates of return. So that's an important ongoing extension. There are issues about how to measure time-varying disaster probabilities. So I started by looking at the history and pretending that disaster probability was a constant. And then I got a number like 4% per year. But in practice, that number evolves. And you can't just use the long-term data to pin down exactly the time-varying evolution. So one approach that has been implemented is to look at stock price index options. For example, the VIX is a version of that, and use the variations in that to try to assess what the market thinks the disaster probability is. So there's been some success, I think, along those lines. And as I mentioned before, It's surprising to me these days that these indicators give a disaster probability that's not very high, whereas my own observation of what's going on would be that the disaster probability is still elevated. So that's why I have a disconnect with what the market is saying. There's also been a lot of work by Nick Bloom and co-authors about measuring uncertainty, which could include disaster probabilities, from media coverage and also from government policy statements. So that's another aspect. So let me just finish with two final observations about this area of research. One is that macro uncertainty in various forms has become a central topic in analysis of macroeconomic models and related financial market models. So much of this research features a strong interaction between macro and finance, and I think that that's an important development. In terms of the more specific research that I myself have focused on, I think of the probability and size distribution of rare macroeconomic disasters as one component of this broader area of macroeconomic uncertainty, which I say is being explored along various dimensions. So that's where I stand in terms of this work at this time. Thank you.
Thank you, Governor Lee, and thank you to the Bank of Korea for inviting me to address this audience. I'd like to present some material on the second phase of global liquidity. And for this, let me explain what global liquidity is and why we're in the second phase of global liquidity. So broadly speaking, global liquidity has to do with a global factor that's associated with credit availability and compressed risk premiums, exactly the kind of compressed risk premiums that Bob Barrow was describing just now. And in particular, there's a very strong cross-border element, and it's driven very much by monetary policy at the center. Let me motivate this with some very basic national income accounting. I think this is where we need to rethink some of our basic building blocks. Now, our basic unit of measurement is the boundary that surrounds the economic territory that defines output, that defines consumption, and so on. And where we draw the boundary is pretty much arbitrary, but it more or less follows the national boundaries. But what we do in economics goes beyond this arbitrary boundary in measurement, and we give it two more elements. So the first element is that we make the national boundary also the unit of decision making. So we give the national boundary a balance sheet, and we imagine that there is a decision maker in that economic territory that's making some economic decisions, consumption, investment, and so on. So that's the first element. And then the second element is that we also, in the simplest models, identify the national income boundary with the currency area. So we think of the exchange rate as the relative prices across economic territories. That means that our focus is very much on the current account. It's on the net claims. So, for example, if economic territory 1 is in deficit, then there has to be a countervailing capital flow, because capital flows into economic territory 1 in the sense that economic territory 1 is incurring liabilities against economic territory 2. It also means that if we identify the national income boundary with the currency, then if you allow free floating exchange rates, then you can achieve monetary autonomy as well. So if the exchange rates will adjust, and essentially the monetary policy that's affected, that is conducted by the central bank in economic territory 1 affects only the residents of 1, not 2. So that is the caricature of how we normally approach international economics. But what is the reality? Well, reality is that it's much messier than that. So here is a picture that I will explore in today's lecture, which is on the way that some economic entities, especially non-financial corporates, straddle the border in that they operate both inside the border and outside the border. And so there is no neat distinction between the boundary of the national income area and the decision-making unit. The second element is that this also gives a tremendous role for international currencies in affecting financial conditions, not simply in the area that they come from, but also globally as well. So in this picture, what I have is the international capital markets supplying funding in US dollars to a multinational corporation. The multinational corporation has a unit outside the boundary, but also has some domestic units as well. And this multinational corporation interacts with a domestic bank. Okay? Now, I say a bank, but this could be any other type of financial intermediary. So in the case of Korea, much more relevant here would be securities firms, as I'll describe shortly. So in this case, the multinational corporation is borrowing US dollars, but has local currency assets. And it means that whatever are the external conditions will impact domestic conditions via the actions of this multinational corporation. Now, why do we have two phases of this? Well, in a very coarse way, we can identify two phases of this type of cross-border spillovers in financial conditions. The first phase, which is the phase up to the Lehman crisis, was driven mainly by the banking sector. So this was a phase when you had international banks that were very active. The key theme here is leverage. And the main actors turned out to be the European global banks. So the European global banks tended to be the ones that had the most potent cross-border effects. The second phase, after the crisis, is driven much more by the non-banks. And in particular, it's driven by the bond market. And the bond market includes short-term instruments such as commercial paper, which is much more important in a number of countries like Korea. The key theme is search for yield rather than leverage, and the liquidity is driven by asset managers, the long-term asset managers, rather than banks. Now, we can get a very clear sense of how the shift has occurred through this chart, which is from a paper by my colleague Philip Turner. The green bars are the external liabilities of non-banks. The pink bars are the external liabilities of banks. And these are for broadly emerging economies, emerging and developing economies. And in turn, the green is divided into the deep green, which is the external liabilities of non-banks to bond investors. So these are the international debt securities liabilities of the non-banks. And the pale green is the net external liabilities of non-financial entities to banks. And the same classification holds with respect to the pink. So the deep pink is the external liabilities of the banking sector to the bond investors. And the pale is the external liabilities of the banking sector to other banks. What you see is that the pale squares have really shrunk, which means that we see a much more active role for the bond investors in supplying external financing. And we see this huge shift. In particular, notice how the pink pale bars have completely shrunk. So the types of effects that were prevalent before Lehman are now very much less prevalent. So the interbank external liabilities have really shrunk dramatically. And in its stead, we have a huge increase in the bond investors' role in supplying funding. How can we tell that the European banks have shrunk? Well, here are two charts from the BIS banking series. And essentially, the labeling is too small, but essentially what we see is that the role of the European banks have really shrunk, both in Korea and also in China. So those are just two examples. Now, why is the second phase important, and why would the cross-border element be worthy of note? This chart is from the international debt securities statistics from the BIS. International debt securities refer to bonds that have been issued in a jurisdiction other than the borrower. So the former definition of international debt security was debt securities that were open to international investors. We discovered that that definition was becoming unhelpful because international investors were holding local bonds too. So we narrowed it down to the idea that an international bond is a bond that's issued in a jurisdiction other than the one that the borrower comes from. But even so, we can distinguish two different notions of external liability. The blue series is the international debt securities issued by entities that are resident in China. So under the national income statistics criteria, if you're resident in China and you have issued an international debt security, then that's going to be captured by the blue squares. So this is the net amounts outstanding. The red is the international debt securities outstanding of borrowers that are Chinese by nationality. That's to say, if your headquarters is in China, but you yourself are a registered entity that could be elsewhere, like in Hong Kong, then you'll be captured in the red series. So the red is by nationality, and the blue is by residence, and we see this huge divergence. And this is exactly what we had here. So if the external liabilities are being taken on by the offshore entry, by the offshore element in this diagram, then that's going to be captured by the red, but not the blue. So this chart gives you a sense of the role of the multinational corporation, and already we're seeing that the standard national income statistics will not be capturing the element of the cross-border transmission of liquidity here. If we focus purely on the resident statistics and looked at capital flows in the standard balance of payments, we would be missing the red. The other country that shows a big divergence between the red and the blue is Brazil. And it looks less extreme, but if we take out the public sector debt, then we would see also a very big divergence between the blue and the red. And in both cases, one can attribute this big divergence to the fact that there are very stringent restrictions on movements of capital across borders. So there is an incentive for the offshore entities to be taking on some of these activities. And here is the same chart for India. For India, I'm just showing the non-financial corporate borrowers. Okay, so all these data are publicly available on the BIS website. The picture we have in mind is this. So all those pictures suggest that we should be thinking about activities typified by this diagram, where we have the domestic intermediation sector here. The banks and other intermediaries are intermediating in the standard textbook way from domestic savers to domestic borrowers. But there is a subclass of entities here. They are the multinational corporations, or corporations that have access to capital markets abroad. And they are playing this intermediation role. So they can tap the capital markets, and then part of that funding is going to be flowing back into the domestic financial system. And this is true even though, and therefore there will be a channel whereby global financial conditions will affect domestic financial conditions via the activities of the non-banks. And that is true even if there are restrictions that prevent the local banking sector from accessing global financial markets directly. And who these banks and intermediaries are will depend very much on the financial system and the context. So they could be the commercial banks, the formal commercial banking sector in several countries. In the case of Korea, it's much more likely to be the securities firms. and I will come to this shortly. So here's one very stylized way of how international transactions can sometimes not be captured in the standard balance of payment statistics. So here is an example of a multinational Chinese corporation that has a Hong Kong entity. And here is a global bank based in Hong Kong. And the Hong Kong bank can lend the Chinese corporate US dollars. But in return, inside China, the Beijing office of the corporate can deposit renminbi in the Beijing office of the Hong Kong bank. So that would be the collateral for the US dollar lending. So this is very reminiscent of the 1970s currency swap, where one party deposits US dollars, the other party in those days would be depositing sterling, but in this case we now have RMB. Now the border is here, but there are no cross-border transactions as such. And therefore, if we were looking purely at the current account and purely at the standard national income statistics, we would be missing this kind of transaction. Therefore, we have to think more broadly about how to do the accounting in this kind of situation. And in that respect, many of the issues that we confront with global liquidity really requires us to go back to the very basic concepts of what is a capital flow, what is an external liability, and how do we measure these external liabilities. We can get some sense of how this kind of transaction is reflected in some of the official statistics. If you go to the Hong Kong Monetary Authority webpage, you can download this figure, which shows the external assets and the external liabilities of Hong Kong banks vis-à-vis the entities in mainland China in foreign currency. So the red would be the foreign currency assets, and the blue would be the foreign currency liabilities. And this chart would very much correspond with this picture, where you had RMB assets, RMB liabilities, but then US dollar assets for these Hong Kong banks. Corporate debt has increased tremendously since the crisis, and here is the period of the crisis. Here is the non-financial corporate debt has increased very rapidly after the crisis. For the international debt securities outstanding, we see the biggest increases in the Latin American non-financial corporates. But this is a picture that has been quite general throughout the world. And let me give you one example of the potential consequences of this. And I've taken this series of charts from a recent paper by Andrew Powell from the Inter-American Development Bank. And here is a picture of how global conditions might affect domestic financial conditions via the activities of non-financial corporates. So this is a chart that is a concrete illustration of this chart that I showed you at the very beginning. So the idea here is external conditions via the activities of the non-financial corporates will affect domestic liquidity conditions as well. And what Andrew Powell does in this exercise is to take 4 Latin American countries. So it's called the LAC4, which are Brazil, Chile, Colombia, and Mexico. And then draw the national boundary, but then also recognize that there are foreign subsidiaries of these entities. He notes that there's been a tremendous increase in credit in these 4 countries. So actually this is a pretty universal theme. If we look around, those countries that survived the crisis unscathed have seen an increase in household debt, has seen a huge increase in lending, especially for mortgage borrowing and other consumer loans. And in these 4 countries, there was an increase in credit of over $1 trillion. So from December 2008 to June 2013. And the question is, how was this increase in credit financed? So banks borrow in order to lend. So they've lent $1 trillion more. How did they raise the funding? It turns out that household deposits increased by something like $350 billion. But the non-financial corporate deposits increased by close to $600 billion. So there was a tremendous increase in the claims of non-financial corporates on the banking sector in these 4 countries. But then you can also track how did the corporates raise all that money. And here the diagram gets a little bit more complicated. But essentially, this is a picture where the corporates have increased their liquid asset holdings, but they have also increased their liabilities. So they are borrowing in order to lend. So that's the very definition of what a financial intermediary is. These non-financial corporates are behaving like financial intermediaries in that respect. We normally comment on the increased cash holdings of companies and say, well, why are they holding so much cash? Why aren't they investing with all that cash? We very rarely ask, what's on the other side of the balance sheet? What tends to happen is the companies that hold a lot of cash are also borrowing a lot. And that is a new element in this in the phase after the global financial crisis. And what Andrew Powell documents is that, again, it's the debt securities issuance that has been very, very important in these 4 countries. Now, in the case of Latin America, it's the formal banking sector. In the case of Korea, as I said earlier, it's the securities sector rather than the formal banking sector. The formal banking sector is much more tightly regulated, but the securities firm sector will be much more open to corporate deposits or corporate financial claims, such as through money market funds or money market trusts, MMFs and MMTs. And I would highly recommend that you read the latest Bank of Korea Financial Stability report. I think the English version is coming out very shortly, but the Korean version has been out for about a month. It's a very interesting discussion of the increase in the size of the securities firm sector and how the securities firm sector has increased its claims on the commercial bank sector in Korea. And that's actually a very important issue for all central bankers and all of us to consider, because when eventually global liquidity conditions will reverse, we have to try and figure out what will happen to the assets that the securities firm sector is holding. In particular, what's going to happen to all the commercial paper that is being bought and is being rolled over, and what will happen to corporate liquidity once the global liquidity conditions reverse. In China, there is an institution called entrusted loans, and here is how it works. Entrusted loans means it is a loan provided by one non-financial corporate to another non-financial corporate. So it is not a loan provided by the bank, but the bank simply plays the role of the transactions monitor and just delegated management of the loan contract itself. So if there are some firms that don't have access to global markets, but some firms do, then entrusted loans enable some funding to reach the credit-constrained borrowers, but which is not on the balance sheet of the commercial bank. Again, this is so if the securities firms in Korea are buying the commercial paper of non-financial corporates, and this would be very similar to a entrusted loan like this. So for the Korean audience, entrusted means the Chinese characters is shinta. Okay? This is the entrusted loans of the Chinese corporates, and this sector has become very large, as you know. This is part of the shadow banking system, and the proportion of entrusted loans here in black relative to the formal commercial bank loans has fluctuated from close to 30% all the way down to 10%. And although the term shadow banking has all kinds of connotations, shadow banking simply means that intermediation is happening away from the formal regulated banking sector. And in that respect, Korea also has a shadow banking system. It's going through the securities firms and the non-bank financial intermediaries rather than the commercial bank sector itself. And it's the surrogate intermediation activity of the non-financial corporates which I think is going to be the theme. And it's certainly been the theme since the global financial crisis. Now, we tend to think of firms as raising money in order to invest. And so when you need to invest and you have enough cash, then you use the cash. If you don't have enough cash, then you borrow. So this is the pecking order theory of investment. So in this kind of way of thinking, what you would never see is if they borrow and increase their cash holding. So if they borrow, that's because they lack cash rather than hold more cash. And what we see, in fact, is that this kind of intermediation activity is exactly what we see in the data. So if we look at firms from China, and here I've taken just two sectors and divided the cash holdings by sales, divided the liabilities by sales. So these are all normalized. And you see that there is a broadly positive relationship. So the firms that hold more cash are the ones that also hold greater liabilities. One way of measuring this, and this is, let me now advertise some work that I've done with both IMF co-authors and also some Korean co-authors. And here, two of the Korean co-authors are actually Bank of Korea staff. If you construct a liquidity index in the following way, it turns out to be a very useful way to track activity. So take any country J and compute the deposits of the non-financial corporate sector in local currency, and then convert that into US dollars, and then add across all the countries. So this is a dollar sum that represents the non-financial corporate deposits everywhere in the world. So it's a pretty narrow measure. We're not capturing the shadow banking system. We're capturing just the formal banking sector. It turns out that this measure of global liquidity has a very good, has very useful properties in explaining activity and also forecasting. But what turns out is that converting it into US dollars is not simply just choosing an arbitrary unit of account. If we were to use the euro, for example, as the unit of account, we have a very different series. The only series that comes close to the US dollar is the Japanese yen. And here we see the red. These are the growth rates of this global liquidity measure. The red is the US dollar global liquidity measure. The green is the euro global liquidity measure. And the pink is the Japanese yen. And what you see is that during the crisis, we see this very sharp downturn. And that's because we have two elements that are driving this global liquidity measure. One is the increase in the quantities in local currency terms. The second is the exchange rate changes. Now, the key property of a funding currency is that the exchange rate appreciates during very sharp crises. So we know that the US dollar appreciated very sharply during the Lehman crisis. The Japanese yen also appreciated very sharply. And it's the combination of the exchange rate movement together with the quantity changes that is driving the big forces. So if we use the euro series for the regressions that we use, we find no effect. It has to be one of these global funding currencies. If the global funding currency is such that it appreciates during crisis, we have exactly these kinds of forecasting properties. We've seen a divergence between the US dollar and the yen lately, because whereas the US dollar has not, because the Japanese yen has been depreciating somewhat after in the last couple of years. And what this chart also, I think, presses home is that we need to think of the exchange rate as not simply a gauge of trade and in terms of the trade balance, but the exchange rate also is a very important measure of financial conditions, especially when you have funding currencies that all global players have borrowed in. So if the exchange rate changes, it has global impact in terms of credit availability. The consequences of the unwinding of global liquidity clearly is uppermost in policymakers' minds. One useful lesson can be gleaned from the episode last year. So again, this is from a working paper by my colleague Philip Turner. The first panel shows you just the average local currency yields on government securities. And it's a list of, it's a simple average of Brazil, India, Indonesia, Malaysia, Mexico, Philippines, etc., etc. So a number of emerging market countries. The middle panel is the volatility of the yield changes, and the final panel is the exchange rate. The vertical black line is May 2013. So this was the first hint that tapering would start. And what you see is that before that vertical black line, we had this sustained compression of yields of all these domestic currency government bonds. And then as soon as the tapering talk started, we see this very sharp increase. So it's a very dramatic change in financial conditions in these countries, and that's reflected in the change in the volatility of the yields, and also in the exchange rate as well. What we have to bear in mind is that the events that may play out will play out in a very different way from the way that we have been used to in the light of the global financial crisis. The 2008 crisis was the end of the first phase of global liquidity. That meant that it was a banking sector event. So the key themes are deleveraging, key themes are the interbank markets, and we now know that very well. What this has meant is that policymakers have now focused very much on those intermediate signals like leverage and maturity mismatch as being almost a sufficient condition for gauging whether an economy has financial stability, is vulnerable to financial stability or not. But we should bear in mind that the second phase of global liquidity, because it's driven by a different mechanism, will give rise to very different crisis dynamics. And so here is a potential sequence. And if you remember Nouriel Roubini's sequence during the 2008 crisis of, here are the various stages, I think we can try to come up with a similar list like that and try to use as much knowledge as we can of the mechanisms. And here, I think, is a reasonable sequence, especially given the events last year following the taper tantrum. Whenever you have this very sharp steepening of the local currency yield curve, as in the left-hand panel, this will have a direct impact on local financial conditions. And in this context, we should also think about the potential for funding crisis for non-financial corporates who are highly reliant on short-term commercial paper. So if the paper is not going to be rolled over, that's also going to be an important element. That means that we will have the combination of corporate distress combined also with currency depreciation and a sharp cutback in investment of all kinds. And a cutback in investment is going to be the most volatile component of GDP. So growth is also going to suffer in this kind of scenario. And when growth suffers, the international investors who are most heavily involved in these kind of securities will then have second thoughts about holding them. So one of the main reasons why many fund managers, why many asset managers hold the international debt securities issued by emerging market countries is precisely that these are the countries that have had better growth prospects than the advanced economies. If the growth prospects are then undermined, there is no reason for these international investors to continue to hold them. And because of the various incentives and various risk management systems that are involved at these asset managers, a very natural reaction for them would be to cut back their positions. And as they cut back their positions, we go back to square one, which is to say the steepening of the yield curve will continue because prices will fall, yields will rise. I think this is the element. And this means that we have to think very much more about what the mechanisms are and how we can adjust to the real world. So let me finish there.